Good evening, everybody, and thank you for coming along to hear about PCF Bank this evening. My name's Scott Maybury. I'm a founding director of the business. The presentation will be in next door at the end of tonight's session, so you're welcome to pick up a copy and take it away. It's a lot longer than I'm going to go through tonight. It's got some granular data about our portfolio. We're a lending business, so that's all important. But we've been a financial services business for a long time, well established, but we became a bank in 2017, and it's been absolutely transformational for our business. We've grown from a portfolio of 120 million at the time we were granted the banking licence to about 380 million as I stand here today in just over 2 years. We're one of the new generation of banks. You will have heard about some new banking licences. The old banks have got a bit stale, legacy IT systems, not looking after their customers really. There was a wave of challenger banks who have been a little bit disappointing because they've all just been a little bit mono product and gone into the residential mortgage market, which doesn't have a huge return or NIM, as you will have seen by the products in the marketplace, and they're not really delivering the profits. What we've done is focus on return rather than just scale. So up the top there, you've got the first two lending areas are our traditional areas that we've been in for many, many years. Asset finance to businesses, business critical assets, engineering and manufacturing and vehicles. Consumer motor finance, and then the next two down were acquisitions in the last 12 months. So broadcast and media, we bought a company that specialises in TV and film, which is having a great time of it at the moment with Netflix and Amazon doing so well. They're a lending company, cameras, lenses, post-production equipment, and a property finance business in bridging property finance, first charge mortgage against residential bridging for refurbishment. That was our portfolio balance up there at the end of September last year, funded by retail deposits of 270. We've welcomed over 6,000 customers to the bank since we opened, and we have a total customer base of 20,000. Since we opened as a bank, we've really had a focus on moving more prime with our customer offering, and 74% of the originations we make now are in the prime space. We were precluded from that space previously because of our more expensive cost of funds. Access to the retail deposit market means we now have access to the to the prime lending market as well. I mentioned we're focused on return, not just on scale. There's our net interest margin, way ahead of a traditional bank's net interest margin. Return on equity, 12%, despite the fact that we're capital intensive and have raised capital twice in the last 3 years. Impairment charge of 0.8%, all important when you're a lending business, and that's a very good impairment charge, and a cost to income ratio, which isn't right at the top of the game just yet, but for a bank 2 years in, when we've spent almost £3 million establishing the IT systems around the banking system, pretty impressive to already be in the 50s and working down towards 50%. Medium-term targets, we're looking for a return on equity of 15%, keeping the net interest margin above 7% and keeping the impairment charge below 1%. Experienced board and management team, as I said, I set up the business with a colleague who's still in the business as well, and we've been there for in excess of 25 years. I won't spend too long on the operational highlights. They're as at last September. You can have a look at them for yourself. They were released to the market in December, but you can see some of the growth numbers in these financials. 8 million profits up 50%, EPS up 35%. We held the cost to income ratio, although we're building the bank out. We do pay a dividend. We're never going to be a high yielding stock. We see that it's a good discipline, but we also realise that we're a capital intensive business, so it doesn't make sense to pay out a lot of money. And we achieved our first return on equity target of 12.5% in the year, and our portfolio target of 350 million. And both of those targets we set for 2020, and we actually achieved them in 2019. Here's our model. Our customer proposition's about service and outcomes for our customers, good, fair lending products. We attract deposits now through the Best Buy tables. We use that money to support low-risk lending to the marketplace, and we're delivering portfolio growth and sustainable earnings going forward. Here's a makeup of our funding model. We have a small element of the term funding scheme from the government, but as you can see, the majority comes from depositors. That's a range of notice accounts and term deposit accounts between 100 days, 1 year, 2 year, 3 year, 5 year, 7 year, giving us a perfect mix against our lending portfolio. So we've almost got a natural hedge. The average cost of our funding's just a shade over 2%. Average term's about 2.6 years, and that is matching a lending book which has an average term of about 3 years. Here's our lending book here. The largest part being the business finance, consumer finance, the two established businesses, and here you can see the new business of Azul and the new business of bridging starting to establish themselves as part of our portfolio. This graph I won't dwell on for too long because I've got details on each of the business lines on the next few slides, but what this is really showing you is the growth since we became a bank. Here's our lending at a shade over 80 million pre-banking, and here's our lending now across all the divisions where we're achieving really strong growth, adding these new acquisitions to the top and driving the business forward. So eventually we're going to see that being delivered through operational gearing and additional profitability to the bottom line. Going through each of these business lines, this is our largest business line, and what we've had real success here is getting that money out into the marketplace, into the prime marketplace very quickly. Underwriting and lending to businesses has an element of grey matter. An underwriter sits down, he has to understand balance sheets and P&Ls and cash flows. So we were able to do that very quickly. Our existing model lent itself to do that. As you can see, very large market, 26 billion of advances a year are made in this market. It grew 7% last year, and we've got less than 1% market share, so plenty of room to grow. And as you can see, we've successfully grown that business. That compares to our consumer motor market, where we weren't really in a position to start lending immediately to the prime customer. Motor lending is point of sale lending. People expect instant decisions, almost drive away your car on the same day, but certainly drive away your car the next day. We weren't set up like that. We were a near prime lender because of our higher cost of funds, and we've had to spend the last 12 months developing a automated system for motor lending, and that was rolled out in January, and it's showing great success in the marketplace. That means you get an instant credit decision, you get an instant affordability check, you get the documents online, you e-sign across the web, the documents are delivered back, and the dealer is paid so you can drive away with the car. So for us, this is a very exciting area because although we've shown some growth here, that growth hasn't really come from exploring the prime market yet. So you can see, you'll be able to see in this year and next year very strong growth in our prime motor product. Large market once again, very small market share, huge potential to grow. Azul, which is an acquisition, that's the broadcast and media company. It's a direct proposition. It has relationships with Sony and Canon all over Europe, selling cameras and post-production equipment. In the 11 months that we owned the business, we increased the volumes from 55 million to 69 million compared in the 12 months previous. It's had a fantastic first year, really excellent little company, and the sort of niche acquisition that a small bank like ours should be looking to make. And this diversification, we went into this organically. We took a team from another competitor bank. It's first charge mortgages, lending against residential and commercial property, anything from 6 to 18 months, lending for refurbishment to properties. Once again, a very large market. The board gave the approval to do a 20 million pilot scheme. We reached 20 million of lending by the end of last year, and we're going to push that onto a 60 million portfolio over the course of 2020. So once again, a new and exciting area. And what these are giving us is diversification of our income flows going forward. So we've still got the strength of our traditional business, which we're extremely good at and has performed very well, but we've got these new business lines attached to it as well. I won't dwell too much on 2019's achievements. You've seen the profitability and you've seen the success of the business. So let's move on to what we're doing in the future. We won't be standing still. I've spoken about the launch of the new consumer product that's already gone live and already showing very impressive volumes coming from the marketplace. We're now going to spend some time taking the knowledge that we learnt from building a consumer system, and we're going to circle back and create a new system for our SME lending, which will give our brokers and intermediaries a very good experience, and we'll take this on to a new level. Although it's been a very successful area for growth for us, we believe we can double up on that by actually improving the experience to our customers. And for Azul, it has, as I said, a capability to lend right across Europe. It has Sony's contract for all their broadcast equipment across Europe. That potential hasn't been realised, and we're building up a panel of banks. We don't feel it's the time to be taking European credit risk on our own balance sheet right at this moment, but we can certainly broker that business on to banks in Europe and take fee income for those opportunities. So that's one of our initiatives for that business. And I've already spoken about the property lending side, which is going to move on to 60 million. There's our investment case. I think the strongest points are there that we're UK focused, so we're well positioned for a turnaround in the UK economy going forward. We have a banking licence, so we have access to retail deposits, which is a £400 billion market. As far as investors go, 63 million of income is already sitting on our balance sheet for lending we've already done. So that gives you a certainty of earnings going forward, and it actually provides 65% of next year's financial operating income is already on the book. So that gives some sort of quality of earnings going forward. I've talked about the management team and why we're very confident in our position in the marketplace and our continued success. Small market share, diversified income streams, good quality portfolio with a low impairment charge, access to the retail deposit market, and operational gearing will kick in the future years. There's some numbers for you. These are consensus numbers based on last year's actuals, 8 million profit, 2.5 times that in 3 years' time. Lending portfolio, 3 times, and it is accepted to get there that will be some form of capital event in the future years, but even still with that, you're seeing an EPS double over that period. So I think that just, in summary, that just shows you the strong portfolio growth we've achieved since becoming a bank. It shows the initiatives that we've put in place. Consumer motor is just starting to bear fruit for us. We're results orientated. We're not just looking for scale and big balance sheet. We've got a track record in M&A and consolidation, and making 3 corporate acquisitions over our lifetime, and also buying portfolios. We do pay a dividend, although it will be modest, and there's substantial opportunity going forward for our business in our space for a market that actually has been a little bit spoilt by the legacy banks who haven't really been performing and looking after businesses and consumers. So that sums up the business. I'll take any questions. If you want any independent validation of us. We're Investors Chronicle portfolio bargain shares for the year. As well as my faith in the business, they've got faith in us as well. But we've been around for a long time, so happy to take any questions.
So we've got any questions in the room? I think we've got one just there, and then maybe we'll come to that question there.
You mentioned Best Buy tables.
Yes.
Are you featuring there high up, or do you just appear intermittently? And secondly, have you lost any money through bad debt, insolvencies in the business finance side?
Well, we're a lending business. Yes, we do have arrears and delinquencies. That's all part of lending. Your first question, I talked about the number of customers, 6,000, the size of our deposit base. I must admit, I don't spend a lot of time on it because it's almost the easiest part of banking, attracting the money. We use the Best Buy tables, so Money Champion, Money Supermarket, the Times, the Mail, those lists. You'll see us in there. They only really report the top 5. You don't want to be at the top. The money almost floods in. It's almost too much money and you end up turning off the product, and you don't want to do that. You want to be consistent. So you want to come in at about 3rd or 4th and just keep it ticking over. So you'll see us in there regularly in all the products, and we dip in notice account and term depending on what we need to balance up our portfolio. Losses, business losses, slightly higher than consumer losses on the book. So I've set a blended rate of 0.8 across the book. I've been in this business for a long time. The last global financial crisis was more about business failure than it was about personal insolvency and personal debt. But I've seen it go both ways around. We target a bad debt impairment charge of less than 1%, and if we keep it there, that's certainly a superior rate for our type of lending and our sort of business.
I think there was a question just there in the...
Hi.
Hi.
I've got a couple of questions from events in the last week. I mean, we've just seen a German bank masquerading as a up-and-coming bank in this country closing all its UK accounts arbitrarily. Has that actually affected your business and company at all? And the second question is, from a perspective of a private investor, it's very difficult on the profit and loss and balance sheet to judge the integrity of a financial institution. I mean, just last week we had a company who'd been whacked another £30 million by the financial regulator for mistreating its customers. Do you think that modifying, say, for instance, the director's bonus scheme so that they would not vest or cease to be in the event that the company ever got a fine, would that actually help increase integrity and make it easier for a private investor to actually trust a financial institution?
Yeah, and that's fair cop. Let's deal with N26 first, which was just a passported bank from Germany into the UK. They blamed Brexit. I blame their business model. They're more akin to the fintech banks that are around that are raising lots of money but really don't have a solution for making money because they don't have a lending portfolio. They have fantastic technology, excellent pink cards, wonderful experience as a customer, but they're actually not putting that money to use. And that's not what banking is about. They will be consolidated at some point in the future for their technology, not for their profits, most likely. Coming back to trust in banking, absolutely. As I said right from the outset, we're a new breed of bank. Banking disgraced itself. It's not the first time it's done it, and I hate to tell you as well, some banks don't learn the lessons and they just continue to not price properly for risk, which is criminal in a lending business. As far as getting trust back into the banking sector, I think there's a number of small specialist banks like ourselves and a couple of the challenger banks who have done very well. I'm very proud of our profit performance. I'm very proud of our heritage, but there's no doubt that one of the key things that we have is an absolutely clean slate with the Bank of England and the regulator, and I plan to keep it that way. That's worth every bit of the profit that we generate, because to get yourself into the sort of trouble where you have to pay massive fines and massive redress to consumers is an absolute drag on your business. SMCR, which I'm not sure whether you're aware of, the senior manager regime, was brought in to address exactly the points that you're dealt with. So there's malice and clawback in all the senior directors' contracts of a bank, which means that bonuses and any reward can be not just stopped but actually clawed back for bad regulatory conduct or bad profit performance. So I think they've put the ingredients in place, but I also believe that people like yourself who might have doubts over financial services probably just need to reflect over a period of time and see that banking actually has changed.
Excellent. Thank you very much. Just time probably for one more quick question, just there.
How does your consumer business, sorry, thank you. How does your consumer business sit against that of S&U? Do you compete with them directly? Are you targeting different customers, different prices? I'm just interested to see how you compare.
Just very quickly, because I know we're out of time. Their top credit grade probably overlaps with our bottom credit grade. So they're unashamedly a near prime and subprime lender. Very, very good at it. They set themselves on door knocking home credit. So they're set up to collect right across the UK. They're successful at that. They do a good job. They just have that product. We're a lot more diversified than that. But in our consumer motor, we're prime, and they're a little further down the credit spectrum.
Great, thank you very much. Great, thank you very much for that, Scott.
Okay,
Appreciate
thank you.
it.